Here are the topics that we will cover in this section. Asset allocation is the third step of the wealth management loop.
What is asset allocation?
It is an organized and effective method of diversification of investment. The main goal of asset allocation for a client is to maximize return for his chosen level of risk. This is achieved by composing a portfolio on what is called the efficient frontier. Let me explain. Efficient frontier indicates the maximum return for a given level of risk. Constructing a portfolio on the efficient frontier is not easy.
Who constructs this portfolio for the client?
The investment advisor would do the financial planning and define the asset allocation. Thereafter, the portfolio manager will ensure the actual investment based on inputs from a research team. The investment advisor is also responsible that the risk profile is maintained at all times for the client.
It is then essential to conduct periodic reviews of the portfolio.
Yes, let me explain what is required. It is called portfolio rebalancing. The objective of rebalancing is to reset the portfolio, such that the asset allocation basis risk profile remains the same. Let's understand this with an example. Let me ask you a question.
Sure.
The portfolio returns after 1 year are given here. You need to first calculate Sonia's overall return on investment for the year. Well done, that's the correct answer. Here are the calculations. Can you now calculate her asset allocation at the end of 1 year?
Sure.
Well done, that's the correct answer. Here are the detailed calculations. Finally, what action should you take to restore Sania's risk profile? Well done, that's the correct answer. Let's see the detailed calculation. Intuitively, this makes perfect sense.
To rebalance, we should sell the asset class whose prices have gone up, and buy more of the asset class whose prices have gone down.
The investment advisor must record and track the original asset allocation strategy discussed and decided by the client. Let's now summarize the steps of portfolio rebalancing. Rebalancing is also required if the client's risk profile itself changes over time. Tracking and rebalancing of the client's risk profile can be done only on constant engagement and interaction with the client.
How frequently should the portfolio be rebalanced?
The optimal frequency of portfolio rebalancing depends on various factors. Understand these factors in a little more detail. Fees and commissions to be paid to the intermediaries for executing these transactions. The sale of an asset class may attract a tax incidence that the client may wish to avoid. In our example, telling the client to sell equities when it has generated a good return will be a challenging task. Let us end this section now and summarize all that we learned.